Imagine this. You wake up, grab your phone, and the first thing you see is a headline in bold letters, "Markets crash." Your portfolio is suddenly down thousands of dollars. One voice in your head whispers, "This is your chance. Buy the dip." Another voice says, "Don't change your plan. Just keep investing every month." If you've ever felt that tension, you're not alone. This decision, whether to buy the dip or stick to monthly investing, is something every long-term investor will face, many times in their life. Today, we're going to explore the two strategies, understand their strengths and weaknesses, look at real historical data, and finally, help you figure out which one fits you best. Over the course of a lifetime, markets will test you. If you invest for 30 years, you're likely to experience at least 6 or 7 major market crashes, not to mention dozens of smaller drops. Each time, you'll be tempted to make a move. The reason this decision is so important comes down to 3 things. First, volatility is unavoidable. History shows that the S&P 500 has a 10% drop roughly once every 2 years. You can't avoid it, the question is how you react. Second, the best days often hide inside the worst weeks. Research from J.P. Morgan found that missing just the 10 best days in the market over 20 years can cut your total returns in half. The twist? Many of those best days happen right after big crashes. So if you panic or mistime your entry, you can lose out massively. Third, your emotions are your biggest enemy. Psychologists call it loss aversion. Losing money feels about twice as painful as gaining the same amount. This pushes many investors to sell low and buy high, exactly the opposite of what works. So, the real question isn't just which strategy makes more money. It's which strategy will I actually be able to follow, even in a crisis? Buying the dip means adding extra money to your investments when prices fall significantly, for example, when the market is down 10%, 15%, or more. It's like seeing your favorite sneakers suddenly on sale. If they usually cost $100 and now they're $80, you might buy 2 pairs. Investors feel the same way. When prices drop, they want to grab more. The benefit is clear. If you buy at lower prices and the market recovers, your returns can be higher. The challenge is also clear. Nobody rings a bell to tell you when the market has hit the bottom. You might buy, only to watch prices drop another 10%. And for this strategy to work, you need extra cash ready, which means you can't always be fully invested. Warren Buffett loves to say, "Be greedy when others are fearful." It's good advice, but remember, Buffett has billions in reserves and decades of experience. For most of us, buying the dip feels easier in theory than in practice. Monthly investing, sometimes called dollar cost averaging, is much simpler. You invest the same amount at regular intervals, whether the market is high, low, or flat. For example, you might put in $500 every single month, no matter what's happening. Over time, this smooths out the price you pay and takes emotion out of the equation. The beauty of this approach is discipline. You never have to guess if today is the right day to buy, you just follow your schedule. Historically, this method has worked very well for long-term investors because it keeps you in the market through both the good days and the bad. The trade-off is that you don't get to take advantage of dips as aggressively. You'll be buying during highs too, which can feel frustrating when you see a sudden sale in the market. Let's take a look at history. Imagine 2 investors starting in January 2000, right before the dot-com bubble burst. Investor A, monthly investing, puts in $500 every month without fail. Investor B, dip buyer, keeps money in cash and only invests when the market drops at least 15%. Putting in a lump sum at those moments. Over the next 23 years, Investor A stayed fully invested the whole time. They bought during the 2000 crash, during the 2008 financial crisis, and during the COVID crash in 2020, all without changing their routine. Investor B waited for big dips and then invested heavily. When they timed it well, they saw bigger short-term gains. But they also sat in cash for long stretches, missing some of the strongest rallies that happened between dips. The result? Over that period, Investor A actually ended up with slightly more money, not because buying the dip is bad, but because missing just a few strong years hurt Investor B's returns more than the dip purchases helped. The lesson? Being consistently invested often beats trying to be selectively invested, unless you're exceptionally good at timing. The truth is, there's no one-size-fits-all. The best strategy depends on your personality, discipline, and financial situation. If you want a simple, low-stress approach, prefer not to watch the market every day, value long-term consistency over short-term gains, then monthly investing is your best friend. It removes the pressure to guess, and history shows it works for patient investors. If you have extra cash reserves ready, can stay calm during volatility, enjoy studying market trends and are okay with the risk of being wrong, then you might mix in some buy the dip opportunities to boost your returns. But you still need a base level of regular investing so you're never fully out of the market. Here's a strategy many experienced investors use: keep 80 to 90% of your plan in monthly investing for stability. Set aside 10 to 20% as opportunity funds to buy during significant market drops. This way, you get the discipline of regular investing and still have a little firepower when the market goes on sale. You're not betting your future on timing alone, but you also won't feel like you missed a big chance when the next crash comes. No matter which strategy you choose, mindset is the real key. Here are the 3 mental habits that separate successful investors from frustrated ones. Patience over perfection. You will never buy at the absolute bottom, and you don't need to. Getting close enough, over and over, is what compounds into wealth. Consistency over excitement. Big wins feel good, but boring discipline is what quietly builds your $1 million portfolio. Focus on the long game. Your goal isn't to win this week or even this year. It's to have a portfolio that works for you in 10, 20, 30 years, regardless of the path it takes to get there. So, should you buy the dip or stick to monthly investing? If you want the simplest, most reliable path, stick to monthly investing. If you have the skill, cash, and temperament for it, add a small dose of dip buying to capture extra gains. But remember, the most dangerous thing you can do is freeze, doing nothing out of fear while your money sits idle. As the saying goes, the best time to plant a tree was 20 years ago. The second best time is now. Your wealth won't be built in one dramatic moment. It'll be built on thousands of small, boring, consistent actions. So start your next investment, whether the market is at an all-time high or in the middle of a storm. Because the real secret isn't the perfect timing. It's time in the market, and the patience to let it work for you. If you found this video helpful, don't just walk away, give it a like, hit that subscribe button and turn on notifications, so more people can discover it. Thanks for watching, see you.